Welcome to this explainer. Look, if you're operating out there in Alberta's resource, agriculture, or construction sectors right now, you already know the reality on the ground. The stakes? They have literally never been higher. We are talking about gritty, real talk business environments here. Your margins are tight, deadlines are absolutely unforgiving, and honestly, the equipment you choose to use can literally make or break your entire year. So today, we're cutting through all the noise. We're going to break down the exact, real-world strategies for scaling your operations, acquiring the right heavy equipment, securing the financing to actually pull it off, and locking down those land agreements that serve as your foundation.
Now, here's a provocative question for you to think about. It's the exact problem contractors and producers are facing every single day out there. How on earth do you scale a business when the tools you need, like a heavy-duty production dozer or an articulated truck, can easily cost as much as a house? The financial pressure is just immense. You can't just throw money at the problem and hope for the best. A single wrong decision on a machine or a lease, that can eat up your profit margins for an entire season. So grab a notepad, because here is our step-by-step playbook. We're going to cover 1. The Alberta equipment boom. 2. Buy, rent, or lease. 3. Choosing the right machine. 4. Financing your business growth. And 5. Contracts and inspections.
All right, let's jump right into Section 1, the Alberta equipment boom.
Okay, let's dive into this. Just look at the sheer, massive scale of the economic pressures and the opportunities in the local market right now. Operators are getting squeezed from all sides. You've got CUSMA tariffs and global trade volatility messing with input prices, right alongside strict new emission standards that are just pushing operating costs higher. But at the exact same time, Alberta is experiencing this massive surge in non-residential construction demand. So the work is absolutely there. But getting it done profitably? Well, that requires navigating some incredibly tight margins. The numbers really tell the story here. The Canadian construction equipment market is valued at roughly $2.92 billion for 2025, and it's forecasted to just rocket up to $4.1 billion by 2031. But here's the critical operational hurdle we have to talk about. Over the next decade, Canada is expected to lose about 270,000 experienced tradespeople to retirement. To put that into perspective, that is a staggering amount of boots to fill. You have a booming market, tons of projects, but a shrinking pool of seasoned operators. This means every single equipment decision you make carries way more weight than it used to, simply because your machines have to work harder and smarter. Moving right along to Section 2, buy, rent, or lease. And this brilliantly illustrates the strategic dilemma you face whenever you need new hardware. See, owning your equipment outright builds long-term equity. It gives you those capital cost allowance tax deductions here in Canada, and it really boosts your daily productivity because your operators get completely familiar with the exact quirks of that specific machine. Plus, you control the maintenance schedule. But renting offers incredible cash flow flexibility with absolutely zero long-term maintenance costs. It's absolutely ideal if you only need a specialized piece of iron for a few weeks between your core projects. So the basic rule of thumb is this. If utilization is high and the work is consistent, buy it. If the machine is going to sit idle between projects, rent it.
Okay, Section 3, choosing the right machine.
Listen, getting the wrong machine doesn't just mean you're stuck with a hefty repair bill. It costs you valuable crew hours, blown timelines, and ultimately, it can damage your client relationships. So let's quickly break down the heavy hitters you really need to know about. First up, excavators. The 20 to 45-ton class is essential for your heavy commercial and civil earthworks. Second, the skid steer. Honestly, this is often the single most practical first buy when you're building a fleet from scratch, just because of its unmatched versatility and ability to run multiple attachments in tight spaces. And third, articulated trucks. If you're working in soft ground, steep grades, or those remote northern Alberta access roads, an articulated truck is going to keep working long after standard haulers get completely stuck in the mud. But then comes the big question. Do you buy new or used? New machines offer 1 to 3 year warranties, the latest fuel efficiency, and highly predictable maintenance. However, the used market is where most contractors actually find their financial footing. Why? Because used machines are generally 30 to 50% cheaper, and you entirely avoid that brutal first-year depreciation hit. The absolute golden rule here, the sweet spot, is finding a used machine under 5,000 hours that comes with a complete, fully documented service history. Let's shift gears to Section 4, financing your business growth. Now, what's really interesting about this slide is that finding the machine is really only half the battle. Now we actually have to pay for it. Matching the right financial product to your specific operational problem is honestly half the value of acquiring capital in the first place. For instance, if you have a highly seasonal business with strong card volume and you need cash literally tomorrow, a merchant cash advance can fund in 24 hours. Got a one-time project or looking to buy out a competitor? A traditional term loan over 2 to 7 days is your best bet. But if you're constantly stressing over bridging payroll while waiting for slow-paying clients to clear your accounts receivable, a line of credit is exactly what you need.
So, what does it actually take to get approved for these fast capital alternative lending options? Let's rapidly punch through these baseline requirements. Typically, you're going to need at least 6 months of operating history, a FICO score of 500 or above, and 6 months of clear business bank statements. But here's the secret to alternative lenders, and this is a real game changer. They often waste strong, consistent cash deposits, specifically $35,000 or more in monthly business deposits, way more heavily than just a single personal credit score. At the end of the day, cash flow is king. It's also incredibly important to look into specialized funding. If you are operating outside the major metropolitan hubs of Calgary or Edmonton, organizations like Community Futures offer business loans up to $150,000, specifically tailored for rural Alberta businesses. Also, major banks offer dedicated equipment lease lines of credit. This is brilliant because it preserves your main working capital for your day-to-day operating and input costs, while totally separating your heavy equipment debt. Finally, we have Section 5, Contracts and Inspections. Consider this your mandatory before you sign moment, because whether you're buying iron or renting land, this is exactly how you protect yourself from deals that go horribly, horribly wrong. If you're buying used equipment, you have to follow this pre-purchase inspection step by step. Number 1. Check the actual physical condition of the pedals and the seat against the hour meter. Do they match up? Number 2, always, always do a cold start. A warm engine can hide a lot of really expensive secrets. Watch the exhaust and check for milky coolant. That means water is getting into the system. Number 3, test every single hydraulic function fully. And number 4, inspect the undercarriage on tracked machines. Sellers love to gloss over this, but it is by far the most expensive wear item to replace. And what about the actual physical foundation of your business, the land itself? Land rental agreements in Alberta's agricultural sector are getting increasingly complex. Your written agreement absolutely must be ironclad. It needs to clearly define the compensation structure, like is it cash rent or is it a crop share? It must outline acceptable farming practices, right down to the nitty-gritty of weed and disease control, and specifically details strict termination conditions and liability insurance requirements. Look, handshake deals, they just don't cut it anymore.
So the crucial point is that your land agreement must be fully aligned with Alberta laws and reviewed by a legal professional. An equitable, well-documented agreement is your only real protection against disastrous disputes. We're talking about arguments over restricted chemical usage, organic certification violations, or even figuring out what happens to your crops if the leased land is suddenly sold right in the middle of the season. Let's move to and see how this builds our final takeaway, perfectly synthesized in this quote. Getting the right machine on your job site starts with talking to the right people. Because scaling your operations in Alberta isn't about guessing, not at all. It's about thorough preparation, deeply knowing your market, meticulously inspecting your assets, locking down your contracts, and building trusted, solid partnerships with lenders and equipment agencies who actually understand your timeline.
I'll leave you with this final provocative thought. Is your business truly ready for its next big contract? Because you now have the strategic playbook to assess your equipment needs, find the capital to actually fund your growth, and protect your assets on paper. The next step? Well, that's just taking strategic action. Thanks for joining me on this explainer, and I really look forward to seeing how you apply these strategies out there in the fields.